Hello, and welcome to this tutorial on forward rate agreements. Let's start with the definition. A forward rate agreement is a cash-settled contract between two parties, a notional borrower and a notional lender, that effectively fixes the short-term interest rate on a notional amount starting on some future date agreed. Now, the notional lender does not actually lend to the notional borrower. Instead, net payment is made to offset the effect of a benchmark interest rate being higher or lower than the rate fixed in the FRA. For example, a FRA might fix the 3-month rate at 4% on $10 million in 6 months. So if 3-month US dollar LIBOR is higher, let's say it's 5%, then the notional lender would owe the notional borrower the difference between 5% and 4%, and they would owe that on the notional amount, $10 million, multiplied by the fraction of a year, according to the day count convention of that market. So if we're in the US dollar market, it would be 360 days, and then this 91 would be the actual days in that period. Now, if 3-month US dollar LIBOR is lower, 3%, then we'd use the same relationship, but we'd use 3% instead. And here, the notional borrower would owe the lender the difference. Now, how are FRAs quoted, traded, and used? But first, let's talk about the quoting notation. We'll see this M by N notation, where M represents the starting month and N the ending month of the interest period of interest. So a 6 by 9 FRA, for example, would fix the 3-month rate, the difference between these two, starting in 6 months and so ending in 9 months. 2 by 5 FRA would fix the 3-month rate starting in 2 months and ending in 5 months. And you could even have things that aren't FRAs set on 3-month intervals. You could have a 7 by 8 FRA, for example, and that would fix the 1-month rate starting in 7 months. Now, sometimes you'll hear the term buying or selling a FRA. Buying refers to the side that takes the benefits from a rise in rates and loses from a fall, and the seller is the side that benefits from a fall in rates and loses from a rise. Now, it's important to note that this is sort of the opposite of the position one would have if one were buying a bond, where one might benefit from a fall in rates and be harmed by a rise in rates. So here we're basically focusing on the interest rate level rather than the price that we'd be looking at with a bond. Now, a floating rate borrower who buys a FRA is effectively fixing their interest for one or more future periods. And they may buy more than one FRA. They could buy a string of FRAs. Floating rate lender could be doing the exact same thing, but of course they would want to sell the FRAs to protect against a rate fall. Now let's look at an illustration. Suppose we have a small business and the owner is concerned about rising interest rates and what that could do to their interest expense in the coming quarters. Now, they've got a loan outstanding with $1 million balance, and they pay interest every 3 months based on 3-month LIBOR and a spread of 2%. So let's say the loan interest rate was just set at 3.8%. That would have been because LIBOR was 1.8, and then they add the 2% spread to that, and that gives them their 3.8%. So we then take that 3.8% and we multiply it by the fraction of the year according to the day count convention for that market and according to the actual number of periods in that period, in that next period, and then multiply that by the amount of the loan. So this is the amount of interest they would expect to pay at the end of 3 months based on the rate that was just reset. Now, the owner is worried about rising rates over the next few months, as I said, and they imagine rate go to 4% or even 5%. And it doesn't take a lot of work to calculate what that would do to their interest expense. Essentially, if rates go to 4%, their coupon with the 2% spread would be 6%. And so they'd be paying that 6% on the fraction of the year on their balance, and they would be paying $15,167, much higher than the $606 they're paying in the current period. And if rates went to 5%, that gives them a coupon of 7, and their interest rate 1,694. So what can they do? Well, bank, and their bank offers them a 6x9 FRA, and they have a rate of 2.7%. They could use this to hedge interest exposure, essentially 2 quarters out. And how would this work? So if LIBOR goes to 4%, as we imagined in scenario 1, they would, on the FRA, they would have a gain because they bought. The business owners bought, and the gain would be based on the difference between the 4% that was realized and the 2.7% they fixed with their FRA. So we take that difference, multiply it by the fraction of a year, and multiply it by the notional amount, and we come up with 3286. Now, what is that 3286? Well, that 3286 is a gain paid by the bank business owner. Now they're still paying the interest on the loan, and they're paying a higher interest on the loan, 15,167, but they can offset this 3286 against that. So we take the 15,167 that they would be paying in this high rate scenario, we subtract the 3286 gain that they got on the FRA, and they end up with a net payment of 11,881. And this in effect gives them a lower effective loan rate, because this 11,881 divided by the $1 million and then grossed up for a full year actually works out to be 0.7%, which is what we would expect because we've fixed the 2.7, which essentially is fixing LIBOR, pay a 2% spread, so we add that 2% spread, and that gives us our 4.7%. And this table summarizes how the calculation would be done. Now we could also do the same calculation for scenario 2. And in this case, the amount of interest would be higher, 17,694, reflecting the higher coupon and the higher LIBOR. But they're also going to get a higher payment on the FRA, which will exactly offset, again, the difference. And notice we'll end up again with 11,881, and we'll end up again with an effective loan interest rate incorporating the gain on the FRA of 4.7%. Now, how does the bank do this? How do they hedge the FRA that they just sold to their client? Well, they could do another FRA with another bank, perhaps. But they could also replicate the FRA, and they would do it the following way. Suppose current 6-month LIBOR is 2.1% and 9-month LIBOR is 2.3%. So the bank is going to lend an amount of money that will give them the notional amount of their FRA, $1 million, in 6 months. So that turns out $989,495, and that's the exact amount that if they earn 2.1%, our 6-month LIBOR rate, for 182 days, they would end up with $1 million in 182 days. Now they're also going to borrow that same amount of money at 9-month LIBOR, which will be, let's assume, in 273 days. So the amount they have to pay back will be the amount of the loan plus principal and interest. So the interest is going to be 2.3% for a longer period, and that will get us $1,6,753. So this is the amount the bank will need to pay back in 9 months. So the bank, in effect, has done a transaction that realizes the break-even forward rate. They essentially have committed to borrow $1 million in 6 months for a period of 3 months at the rate given below. So they're going to get this amount in 9 months, or rather they're going to pay this amount. They're going to get this amount, they're borrowing it in 6 months. And the rate of interest they're going to get is going to be based on the number of days in that period, which is the difference between the 273 and the 182. And that comes out to be 2.6715%. So we could look at this in terms of cash flow diagrams. So remember, they have lent for 6 months at 2.1. They've borrowed the same amount for 9 months at 2.3. So these two cash flows cancel, and they're ending up with an inflow which would correspond to a borrowing in 6 months, and an outflow corresponding to repaying the borrowing in 9 months. So they're essentially borrowing for 3 months, starting in 6 months. And that's the cash flow of a FRA. We could also look at this with box diagrams. So here they're lending for 6 months at 2.1%. So that's basically taking this 989,495 today and turning that into $1 million that they'll get in 6 months. They get that amount by borrowing this amount for 9 months, such that we have the same amount here. So plus and minus there canceling out, and we're going to end up with $1 million received and $1,607,553 being paid in 9 months, which again is the cash flows corresponding to a FRA, or what you would need to hedge a FRA. So they've borrowed $1 million. They're going to repay $1,607,553. That corresponds to a annualized rate of 2.6715% using this formula. And then finally, we can look at this using a transaction cash flow table. So here's our lending transaction. Here's our borrowing transaction. Notice that the cash flows today cancel out. $1 million in because we're lending. So this is the loan that's being repaid to us, $1 million. And then we're going to have an outflow as the bank, $1,607,553. So we have plus $1 million coming in 6 months and minus $1,607,553 going out. And again, the same 2.6715%. So all of these last few slides, they're the same replicating transaction, just looked at using different paradigms. Okay, so let's talk about how FRAs actually settle. In the previous illustrations, we were assuming that the payments were made at the end of the period, as they would on a loan. But actually, FRA payments are settled at the beginning of the period on a present value basis, using the LIBOR as the discount rate. So why is it done this way? Well, the net payment is known at the beginning of the period, since LIBOR has been set, and settling the contract at the beginning reduces the counterparty risk while giving the same economic hedge. So essentially, you're giving the same economic benefits without keeping the transaction open. And so the FRA payment that you would get at the beginning of a period has to be discounted by LIBOR. So here is the payment based on the difference between LIBOR and the FRA rate, fraction of a period, and the notional. This was the calculation we did in our illustration. And this is the amount we would receive if we were going to get it at the end of the period, the net end of period amount. But we want to have that at the beginning of the period. And so we need to discount it by dividing it by this fraction here. And that represents our discount factor. So let's look at an example. Suppose the bank sells a 9x12 FRA on $2 million at a rate of 3%. And they've done this with a client that wants to lock in their 3-month borrowing costs 9 months forward, okay? So if in 9 months, 3-month LIBOR is 4%, so higher than our FRA rate, that means the client will receive from the bank the present value of the difference. And the 3 months here, we assume, as we've done previously, is going to be 91 days. So what will the FRA payment be? This is the beginning of period FRA payment. Well, it's going to be equal to the what would be the end of period FRA payment, this amount, calculated the way we've been doing it as the difference in rates times the notional amounts times the fraction of the period. But then in addition, we're going to discount that 3 months at LIBOR, 4%, and we're going to get an amount of $5,005. So this is the amount that the bank would pay to the client at the beginning of the period, right after the LIBOR has been reset. And if 3-month LIBOR went down, the client would pay the bank, and they're going to pay them a difference based on what the rate goes to. So if the rate dropped to 2%, then the payment will be negative, or the client will be paying the bank. This notional amount times the difference times the fraction of a year, the same as the other calculation, and again discounting it, but now we're going to discount it at the LIBOR that applies to this scenario. So it's 2%. And that's why we're going to get slightly different numbers here, even though the rate change was symmetric. The discount rate is going to cause them to be slightly different. So let's try to pull this together with a problem and see how we use FRA to lock in borrowing costs. Suppose we've got a company, they've borrowed $50 million for 2 years with a floating coupon of LIBOR plus 75 basis points, payable quarterly. The current coupon rate has just been set, but the company treasurer wants to fix the next coupon as well, based on 3-month US dollar LIBOR in 3 months. So the first question is, what FRA could the company buy to do this? Well, they'd have to buy a 3x6 FRA, right? Because they want to get the next period. So they want to cover the interest period starting in 3 months and ending in 6 months. So in other words, the 3-month LIBOR that will be prevailing in 3 months. And they want to do that for a $50 million notional to correspond to their loan. Now let's suppose the FRA is priced at 4.25%. What interest rate does that in effect lock in on the loan, taking account of the FRA? Well, it locks in 5% because we've got the 4.25% that the FRAs lock in for us, and we've got the 75 basis point spread on the FRN. So the sum of the two is 5. Now let's suppose 3-month LIBOR rises from 4%, the current level, to 4.75% in 3 months. Would the company treasurer expect to make or receive a net payment on the FRA? Well, they would expect to receive. But they would expect to receive based on the fact that the 475 is greater than the 4.25% that they set in the FRA. And because of that, they'll get a payment based on this difference. If the rate had risen only to 4.25% in 3 months, so it's still an increase, it would just be equaling the FRA rate. And in that case, there would be no payment either way. And if it had risen, but had risen by less than 25 basis points, say to 4.10%. In that case, even though LIBOR has gone up, the company in this case would be making a payment because it was the LIBOR would be less than the rate they'd locked in. Now finally, when is the net payment made? Well, the net payment would be made in 3 months. So even though they're locking in a rate that would be paid at the end of the 3 months, if they're following the convention for FRAs, they'd be paying the discounted value of that notional amount multiplied by the rate difference 3 months sooner. So that's it. Let's summarize. So forward rate agreement, or FRA, is a cash-settled derivative contract that enables a company or bank to realize gain or loss from changes in future short-term interest rates. FRA payoff is based on changes in the benchmark interest rate, for example, LIBOR, and the notional amount of the FRA contract. FRAs can be used to hedge floating interest rates on a loan for either borrowers or investors. And FRA pricing will be driven by the break-even forward interest rate calculation that we saw. And this can be done because the payoffs of a FRA can be replicated by borrowing and lending transactions. And then finally, by convention, FRA payoffs are settled at the beginning of a period on a present value basis. So that's it. Thank you for listening.